The once mighty Amazon is now down over 40% since those all-time highs of 2021, which brings them now to a market cap of 1 trillion US dollars. And check this out, an undefined PE, because Google now recognizes them as an unprofitable company. We'll talk about that more in just a bit, but the stock is actually on a 25% rally since the beginning of 2023. So it's now time to see what's going on behind the scenes by analyzing their year-ending results so that us buy investors can get a good sense of whether this is a buy or a sell at these levels. So make sure to stick around as we'll answer all of your questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we will walk through the fundamentals of this business. We'll talk the trajectory of this business, and using all of our findings, we'll input that into our calculator here to see the buying points that are present with Amazon and conclude off the video with an investment rating. So if you do enjoy this type of content, make sure to smash that like button and definitely subscribe as we post on here regularly. And don't forget to comment your thoughts on today's video in the comment section below. And without further ado, let's jump into the analysis. All right, so looking at Amazon's Q4 2022 earnings, what exactly does Amazon have in store for us investors? And well, as you can see, they missed on their earnings per share guidance. They're saying they took almost a $10 billion hit on their Rivian Automotive investment, in terms of an unrealized losses and gains. So won't look too much into that there. But in terms of revenue, that actually beat analyst expectations by about $3.5 billion there. North American segment sales are up 13% on a year-over-year basis. International sales down about 8% on a year-over-year basis, while their AWS segment, of course, up 20% year-over-year, and what's really driving this business now. Now, they did also mention that they were able to achieve almost 200 million users now for their Amazon Prime service. And as you can see from this chart here from Main Street Financial Data, the first link in the description and a great investing resource there, you can see how their Prime users have expanded over the last few years, steadily increasing year over year, despite this 3 to 4 year period where we've had an economic slowdown here. So that is a great sign for investors to see. Now, if we look at their net sales for the trailing 12 months, we can see that's actually up on a 9% year over year basis. It's actually up 13% on a Forex adjusted basis here to $515 billion, you can call it, essentially for the year of 2022. And I mean, so far, this sounds pretty good, right? Well, you're going to be wrong on that end, because once we get down to our expenses and our operating income down here for our trailing 12-month perspective, absolutely slashed in half, down 51% on a year-over-year basis, down to $12 billion or so. Last year, we were at almost $25 billion, and you've seen this steadily declining quarter over quarter, and we've just hit a new low as well. Now, if we break this down a little further and look at what's actually going on the income statement, net product sales, at least for this year, down just slightly here. Their net service sales, those are actually up, and what's holding up this business, like we mentioned earlier. And so altogether, that leaves them with about $150 billion worth of sales for this quarter. Okay, but because this is the year-ending result, let's take a more macro approach here. Let's look at their year-ending results. And so all in all, we had that boost in revenues from 469 last year to $513 billion this year. Okay, so far so good, but let me add in our cost of sales, which have been increasing, our fulfillment costs, which have been increasing, our massive increase here to technology and content costs, sales and marketing, etc. We're left with $501 billion worth of operating expenses. Only leaves us with that $12 billion worth of operating income here. And again, when you compare that to last year's results, not looking good there, absolutely slashed. And it's because Amazon operates in a business sector where there's a lot of competition in this space, especially on the service side. They have things like Amazon Prime, and a huge caveat to Amazon Prime and that growing number of users that they have is that they need to spend more on entertaining content so that people feel more incentivized to keep their subscriptions there rather than going to another service such as, Netflix or Disney or Apple, etc. Right? And so they're really going to have to spend on not only marketing, but also that content there, really eating up that operating income there. Okay, and if we want to dissect this a little bit further here and we look at this for a regional perspective, we can see net sales in North America have actually increased, but look at the operating expenses there. They've increased by a much larger rate there, and that's why they're left with an operating loss at this point for the full year of 2022. Now, if we look at the international segment, things are looking even worse over there, because at least in North America, we're still seeing some growth in terms of sales. Internationally, we've had a decline there of almost $10 billion or so. Now, that did allow them to cut back on a little bit of cost, but that really expanded their operating loss there to over $7.5 billion. And I mean, the international segment here is not doing well. It has not been doing well over the last few years either. There's a lot of foreign companies like Alibaba, for example, that are going to be competing for that same market share internationally. And a lot of foreigners are saying, why would we support Amazon when we can support our own homegrown companies here? And so that's what's happening with their international segment, not looking good fundamentally. But Amazon Web Services here, net sales are up quarterly and yearly here. Margins are still in a healthy state, and so they're left with $22.8 billion worth of operating income on that side of the business. Now, we know how this story goes. Whenever your operating expenses are increasing at a steadily pace, but your revenues, your gross profit are not able to reach that same level of parity, well, what happens is you're going to see your operating income decline there. And you can see here over the last few years, they've been able to grow continuously, but with the impacts to their international segment and even North America, they're now starting to see some operating losses there, which has Amazon Web Services actually holding up the remainder of the business there from a profit standpoint. Again, this is before we even deduct for taxes, interest, and all the other expenses. So it looks a lot worse when we look at this from a net income perspective. But with all that being said, let's take a look here at this from a liquidity perspective. They actually have about, let's just call it $96 billion worth of cash sitting there on that balance sheet. Very healthy position there with only $50 billion or so of debt. That being said, they do have quite a bit of long-term lease liabilities because they do have quite a bit of property that they have to manage. But on this channel, at least, we're looking primarily just at the debt figures. And so from a cash to debt perspective, we're actually in a very healthy state here for Amazon. And that's good because they're going to need that cash over the next few months, because when you see the free cash flow figures here down 28% year over year to just $11.5 billion now at Q4 of 2022. We've seen that rebound so far over the last 3 quarters, which is good, but it's still a negative figure. And their long-term goal here is actually to optimize their free cash flow. So you're going to want to see how this translates and if they can continue to improve on their free cash flow into the next few quarters, because right now they are bleeding cash. And so what do they do with their cash flows? For the year of 2022, their free cash figures are actually negative. And so there's not much for them to do except for rely on that cash that's on the balance sheet to fund their operations here. And well, management thought that the business was a little undervalued here, bought $6 billion worth of their shares back. Everything else has to do with their debt consolidation here, which isn't something that really attracts investors. But if we look at their guidance for first quarter of 2023, they're expecting between $121 billion and $126 billion. By the time we get down to operating income, they're expecting to come in either break even or at $4 billion of operating income there, which is pretty much in line with what they were able to do the first quarter of 2022. So if we take a look at their operating income over the last few years, you can see how that expanded as well up into those mid $20 billion figures. Now we've had that severe decline for this year, now down to 12 and almost $500 million there in operating income. And so they're expecting about $4 billion worth in that first quarter. If we extrapolate that out over the next year, that's still going to come in line with what they had this year at $12 billion or so for the full year of 2023. So if we get over here to our calculator, if we plug in, just $15 billion worth of operating income over the next few years, in the case that they're sandbagging these results a little bit here, if we require a 10% return, they do not currently pay a dividend. And if they can only grow at about 7% for the next decade on a 30 PE, let's assume that they do achieve profitability here and they can maintain that 30 PE, the stock would only be worth $34 per share. Right now, we're sitting at about $103, meaning from this growth point, the business would only be worth 30% of where it's trading at right now. The rest is all market optimism and a high valuation. Now, in the very best case scenario, where they're actually able to grow at 20% for the next 5 years, then they stabilize out for the 5 years after that on a 14% growth rate. While trading at about a 40 PE, the stock would be fairly valued. Now, this is actually the investment thesis with this business. It's to assume that they can get back to those previous growth rates and get back to those high levels of profitability and strong free cash flows, right? And so if you believe that Amazon can actually get back to those levels there, then it would be fairly valued from this point of view. Now, in the very worst case scenario, let's assume that more bad news comes for Amazon, more competition, less growth, more economic instability. We see a negative 1% growth rate over the next 5 years. Then they're able to grow at, let's just call it like 5% for the 5 years after that on a rebound in the economy and things like that. On a 25 PE, the stock would only be worth $18 per share. Now, of course, this is assuming they can only achieve about $15 billion worth of operating income. Now, if they can actually bump that up to the levels they were previously trading at with about $25 billion worth of operating income, you can see how that changes our results here. They still need to maintain a high level of growth, because with these stable growth numbers here of 7% for the next decade, that only equates to about a $57 price weighting, almost a double from where we are right now. But investors do understand this business is a bit overvalued, sitting at a $1 trillion market cap. But in the very best case scenario, again, if they're able to maintain their high growth metrics, we could see some nice stock appreciation from this business here. And so when we're looking at this from a technical perspective, if we look back into 2019 and into 2020 as well, you can see this business does tend to bounce off this, $80 price range or so, and it doesn't really like to trade down below that. So there may be a floor in here in and around that $100 per share level. But again, you need to understand what you're getting into with this $1 trillion trillion company here, which recently lost the man who put them in this position in the first place. And so altogether, with everything in mind, I'm going to give this an investment rating of about a 5.5. The reason why I'm giving it a 5.5 is because we are near that price floor, in and around that $100 per share figure. But this business is overvalued in my point of view here, at $1 trillion. Now, that doesn't mean that this business cannot grow back to the levels it was previously trading at and make new all-time highs. That is not what that means. It just means we're not trading near that margin of safety level that I typically want to invest in businesses at. And the results that they're producing right now are not quite indicative of a value investment for me, at least. But that is the analysis for today's video. If you do have a differing opinion, please comment your thoughts in the comment section below. Also, if you did enjoy this video, like the video, subscribe, as it really helps out the channel, and I'll catch you on the next one.